Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Ben Rains here for top stock picks at Zacks. Today we're looking at CECO Environmental, trading under the ticker CECO. The company is a Zacks ranked number one strong buy at the moment, and it's a leader in air pollution control, water treatment, and energy transition solutions. Its core business is focused on power plants and heavy industry. This means business is booming as the power-hungry AI data center build-out, reshoring, and a wave of CapEx-heavy economic expansion creates a really once-in-a-generation megatrend for CECO and others to ride. The industrial emissions specialist is projected to easily double both its revenue and its earnings over the next 2 years. The stock has already skyrocketed over the last 5 years as it rides that AI-driven energy boom highlighted by natural gas and more. Yet, anyone who missed this run is in luck since the stock fell nearly 40% from its June records. It's now down around 33% from its highs and attempting to land some support at some key technical levels. Its upward earnings revisions land that Zacks ranked number one strong buy heading into its Q2 release on Thursday, August 6th, which makes it a little bit more risky to buy right now, but it's worth considering no matter what. And if you want to take a small position before earnings and then possibly add to it, if it faces a little bit more pressure afterwards, it's always worth considering. So now let's dive into more of CECO on Zacks.com in our ZRS system for a deeper dive into the stock. Okay, I'm going to start on CECO Environmental's website real fast just to quickly go over their business. So they make everything such as air filters and scrubbers and much more to help an array of critical industries reduce emissions, manage wastewater, and improve overall energy efficiency. It's expanded its reach via strategic acquisitions and is benefiting, as we mentioned up top, via these key megatrends across AI data centers, reshoring and beyond, and especially the natural gas boom recently to help fuel those power-hungry AI data centers. The company's orders climbed 97% in the first quarter, with its backlog up 72%. The impressive quarter was highlighted by what the company called its largest ever order in natural gas power market. So that's really kind of the backdrop we're taking a look at CECO at the moment. So now I'm going to go take a look at its recent revenue growth. So we can see in 2022, $423 million, and then it did $774 million last year. So it doubled its revenue between 2021, that 324 all the way up to 774 million in 2025. So we see that impressive growth after kind of stagnation recently. And then we'll go ahead and take a look at what to expect, because this is where the big jump is expected to come. So we can see it as that Zacks ranked number one strong buy, which I've stressed recently. It's pollution control industries in the top 17% of roughly 245 Zacks industries, which is always a good thing. So this could be part of a highly ranked industry, because then kind of a rising tide lifts all boats for those stocks. So we can see we're calling for 66% revenue growth in 2026 and another 37% growth in 2027. So easily doubling its revenue between 2025 and 2027. And then on the bottom line, we're calling for 121% adjusted earnings growth. So doubling its adjusted earnings in 2026 and then getting all the way up to $2.89 per share in 2027. So massive growth, adding essentially $2 to the top line from 89 cents to $2.89 in just 2 years. We can see that its upward earnings revisions. We're calling for the most accurate estimate for its upcoming quarterly release. So Q2 is up 30% above consensus, which is a great sign, and it beat by 200% last quarter. So that's a possibly good sign of a big beat coming on its release Thursday. We can go ahead and look. These choppy lines are its overall earnings revisions trends. So this is 2027 going straight up, and then 2026 trending in the right direction as well. And now we're going to go ahead and take a look at back here. We're going to go ahead and look at its performance charts and then some technical levels as well. So this is from its highs. It's down about 34% at the moment. But we can see we'll go over the last 5 years, get rid of those surprises. So it's up 876% over the last 5 years, blowing away that highly ranked industries, 40%. And we can go ahead and take a look at it versus the S&P 500. They'll go back it out for the last 15 years. So we can see chopped around for a long time, underperformed, and then this booming mega trend driven by AI data centers and more is really causing a breakout for the stock. And then we'll go ahead and take a look at some technical levels that I mentioned up top as well. We'll zoom this out to a year. So it fell from these June highs, and now it landed some support right below that 200-day, and now as we record this on Monday morning, trying to break above that 200-day moving average. And then it held, let me draw a trend line here. You can see kind of held this late February gap lower levels, held there. And then we go ahead and take a look. 10 years and give a sense that it's trying. So this green line is the 50-week moving average, trying to hold its ground there after going from relatively overbought RSI levels. So this is this orange line I'm going to draw here to now we're kind of the lower end where it's been over the last decade. So down around 33% from its highs heading into its release on Thursday, and it's trying to hold support at that long-term 50-week moving average, that green line here. Let me go ahead and take a look quickly at its valuation as well. So this is forward 12-month earnings. We can see that big pullback mixed with that impressive earnings growth outlook has it trading roughly 45% below its highs as the chart tries to pull up. So it traded as high as 59 times forward earnings and forward 12-month earnings in the last 5 years. It's now trading at 26.2, which is not too far above, or I guess it's relatively far above the S&P 100, but not way out of whack like it was before. And then we go ahead and take a look at it against its industry as well to give a sense of, it's trading relatively in line with that industry, even though it's crushed the industry over the last few years. So the valuation's looking really strong as well. I'll quickly just show that against its industry. So this is over the last 5 years and then over the last 10 years to show that its valuation is pretty impressive here at the moment. And that does it for me. Now I'm going to send it over to Tracy.
Thanks, Ben. So I brought a AI infrastructure stock. It's been beaten up, but the rank has surged back up to a number one, a strong buy after a very strong earnings report for the second quarter. Now, everybody didn't know, is this peak, is the best behind us, but Vertiv, which does the racks and some power management, thermal management, it's inside the data centers. It's also in partnership with NVIDIA. So it's kind of a front runner to what to expect from NVIDIA in a couple of weeks when it reports. It's not one-on-one, but if Vertiv is still seeing great business, then because they're in partnership with NVIDIA, then usually that means NVIDIA is too. So what is going on with the earnings with Vertiv? They're still going up. They beat, they raised in the second quarter, and that's what we've been seeing for a couple of years now, really. But again, the shares have pulled back. Let's take a look at what the price consensus and surprise chart looks like on this Zacks number one. I own it in my own personal portfolio and in Zacks value investor portfolio. We've owned it for a couple of years. So just scrolling down at that price consensus and surprise chart, it is my favorite chart. You can see what is happening with the earnings up and to the right all these last 5 years. This is the consensus, but we now do have this tan line up here at the top. 2028 is in there, and it's also looking pretty bullish there. Of course, that's in the future, and nobody knows, but the analysts are bullish. But the stock market, not so much. As you can see, the shares have fallen in the last month about 24%. But year to date, they're still up almost 40%. So year to date, not so bad if you bought back here in 2025 before the big, surge higher here. But it's making the stock more attractive on a PE basis now. Down here, forward PE now at 36. It was in the 40s at that all-time high there. But look at the PEG ratio. It's at 1. A PEG of 1 and under usually indicates both value and growth. So that's a pretty rare combination. And how are we getting that? Well, the shares are pulling back. So that's helpful on the P side, the price. But we're also seeing this tremendous earnings growth over here in the sales and EPS growth rate chart. Earnings are on the right-hand side. Last year, they did 47.4%. This year, expecting to do 58.1%. And then next year, another 33.7%. on double-digit, very strong sales growth. Now, why do we have that number one? Again, it's not just because the earnings are rising, it's because the analysts have been raising. And you can see scrolling down on the estimate revisions. Now, for the full year, we have 7 that are higher after that earnings report. And now it's really, again, pushed up the consensus to 664 here from 641. And it's been slowly just trickling higher over the last 3 months. And that is the most accurate estimate here, is the 664. Look at next year, though, 888, another big gain and jump for next year. That means the analysts really believe that this demand will remain strong for the data centers. And then we have most accurate estimate is actually a little bit higher at 895 versus the 888. So I'm liking all of that. There is kind of a mix for the third quarter. We have 2 that are higher, 2 that are lower, but that's just everyone getting into line with what the company, guided for. And then for the fourth quarter, they see more coming in that quarter, 4 estimates higher there. So that's what's getting us the good rankiness, that strong buy. It's back there. It's not super cheap, as I said. Just scrolling down to take a look. We said the PE was at 36. We're looking at the value scorecard here, and we do have the stretch price to book of 19.5. Price to sales has come back down under 10, so that's good to see. It is more attractive here at 8 times. And maybe you're wondering, how can the Zacks value investor own this stock when it seems pretty pricey here? Well, it does have that attractive PEG ratio, and the PE has come down. But we bought it 3 years ago when the stock was cheaper on a classic value fundamental basis. Now it's just basically a growth stock, but if I can get that growth cheaper, I'm interested. So I like to buy these stocks in the pullback. Now is the time to buy a stock like Vertiv. It's down big. It's in this temporary bear. It's done this before over the last 3 years when people get a little nervous about AI spending. All the people who had big gains in the stock sell and take those gains, and that provides a buying opportunity for the rest of us. So keep Vertiv on your short list. It is that strong buy rank, and I expect a lot of these AI infrastructure stocks, now that we've seen some of them from the likes of Vertiv and a few others, that these are really going to have the strong Zacks rank this quarter as they beat, they raise, and things still look good with that strong demand. They're all still talking about the strong demand. So those trillions of dollars that the hyperscalers are spending, or at least $1 trillion, are going somewhere, and they're going to companies like Vertiv. So keep all of those on your list, because I am. And right now they're on sale. So check out Vertiv, VRT, and be sure to check out our videos every week here on YouTube, because we do the top stock picks every week. It's 2 Zacks #1 ranked strong buy stocks. This is the time you want to get them during earnings season. Something good is going on at that company, usually a raise in the guidance to get that #1 rank. It's very competitive. There's only a little over 200 stocks out of over 4,000 we cover with the Zacks rank that have the #1 ranked strong buy ranking. Remember, it's a short-term recommendation, just 1 to 3 months. That's why you got to tune in every week to see what new #1s might be out there. But be sure to do it. Get us on YouTube. Get us on Zacks.com/YouTube to get our Earnings All-Star videos there every week, and subscribe so you don't miss a single one. Hit the notification button. Leave us some comments. We do look at them, but be sure to get it somewhere, and we'll be back next week with some more top stock.